An episode of the Community Power Hour. Ask me, ask us anything. Haven't done one of these before, but
You keep saying that. We did one like a year ago.
oh, I'm sorry.
Yeah.
We haven't
It's been so long
Yeah.
that you're eager for another.
Times were very different then.
Times were very
A
different.
lot has changed in the last year, so
Yeah.
very excited. Everyone, bring your most fun questions. They don't necessarily have to be real estate related. Whatever.
Oh geez.
Oh geez.
I don't know that I agreed to that.
The funny thing is, like, we do calls all the time, and always happy to just have a 15-minute phone call with someone. And the most common question we get is not necessarily real estate related. It's like, how do you two stay married and work together? And how does that work exactly? We're always happy to talk about, I don't know, whatever people want to talk about. So whatever's going to serve them. And we're happy to answer questions about whatever y'all have brought. We're come ready. Couple announcements.
Yeah, let's start there.
Yeah, we're going to launch Fund 2. Do we have a firm date at this point, or
June 6th?
June 6th. Very exciting.
I think. Let me check the calendar. We made that decision in a sleep deprived. Yes, June 6th.
Mhm.
We're always sleep deprived.
Yeah.
Thank you, baby Abram.
Yep. So we'll open that up to our previous investors first, and then to people on the wait list, and then to the general public. But we'll have our webinar on June 6th, and that's going to be a ton of fun. We raised 16 million in one day with Fund 1. I'm guessing Fund 2 is going to be a similar telethon situation. So again, it'll be kind of an ask me anything a little bit, just any questions that people have. But we have Tanara Villa Apartments under contract right now for Fund 2. We're very excited about that, and then we're very close to having a second property under contract. We've got a bunch of irons in the fire. I always hate to say we've got something until we've got something. You never know. You never know, but it's a out of the park home run deal. So we're very excited about having that deal in Fund 2 if we're able to make that one happen.
Yeah. I'll do a little teaching on clarity and how important clarity is in any life decision, but certainly business decisions. So we've had Tanara Villa under contract for, I guess, about 7 weeks, because Abram's about 7 weeks old and we got it under contract.
We've been working on it that long. Yeah. Maybe 5 or 6 weeks we've had it under contract.
Yeah. And we flew out to Tacoma. We did our due diligence, met with our operational partner there, put the whole business plan together. And so we've known about Tanara Villa and that would necessitate the need for Fund 2 for a while, but just didn't have a great feeling of when we would launch it. We're closing at the end of July. And so
lots of time.
Yeah, lots of time. And Nick and I are very much believers in intuition and feeling guided by the universe, and just we're very intuitive business people, business leaders. And we just kind of weren't feeling it with launching Fund 2 quite yet. And then we were driving. Nick's mom lives about 2 hours away. So we were driving home.
4-hour round trip drive we get to do on the weekends when we go visit grandma.
with 4 children. So we go during nap time, spend the whole afternoon with grandma, dinner, and then we drive home when the children are sleeping. So we leave at bedtime. So it's a long day. And we have the baby on top of that now. And I just all of a sudden, I said, Nick, we had like 7 million in the bank in Fund 1 after we purchased Nicholas. And we've bought 25 single family homes, and they're an average price of 275, and 25 times 275. Nick, I think we're out of money. And I'm like doing the math, and he's like, I just got one under contract today. And
like two more I was writing offers on, like at that moment.
And I'm like, well, it looks like we're launching Fund 2 like as soon as possible, and we're going to be okay because we have earnest money and all that stuff. So we're not actually,
and then we leveraged them, so we still got ways to go.
But in that moment, I pulled up a calendar, I set the dates, and we just had supreme clarity. And all of the well, do we do it before Memorial Day or after Memorial Day? There was just crystal clarity there. And I share that story just as an example that I encourage you to look for those moments of clarity in your own life and to hone your ability to know that that's what's happening. When you feel that clarity, to know, okay, that's my moment of clarity, and to seize it and to act on it.
Yeah, we almost, I would say, lean into that, like, to a point of fault. Like, if we don't feel a sense of clarity about something, we don't take action. That's not a reason to procrastinate, but it's certainly a reason to wait until you feel convicted. It should never be a push. It should always be a pull. When you visit an asset, you're just like, this is it. Like it's just, this is it right here, you know? And if you don't feel that way, if there's any doubt, there is no doubt. So and
that goes so closely with probably our, I don't want to put a number up, but in our top 5 of other things that have been really important for growing our real estate investments and our business is you just have to do a lot of it. So we are big believers in being operators and being in the Gemba, in the place of real work. And, you know, some people might say you need to work in your business and not on your business. We're kind of 50-50. We really believe in the value of working on the business and in the business too. But the reason for that is by having so many repetitions of something that gives you that crystal clarity when you know it, right? If you walked 100 deals, when you walk into 101, I can look at Nick and just in a second, we both know we want it, we're ready to go. And, you know, we know the narrative in our mind of what we might message to the agent or the seller, whoever it is that we're walking with. And you get that by having so many repetitions that when you feel it, you just instantly know it.
Yep. And there's a lot more detail that goes into it. You always want to check yourself with your numbers and stuff.
Absolutely.
But we see a lot of people who try to kind of drive their investing decisions with the numbers and stuff, and it just doesn't work that way. Like this deal we're really excited about. Sorry, my voice is kind of crackly tonight. We went and walked this deal, and it's like a mile from our office. A nearby, you know, comparable asset sold for like 125,000 unit. This is like 100,000 unit. So we already knew that we were walking into something that needed some help, but the discount was there. And all we need to get is that, you know, 20-25% margin in a deal to be able to get to a cash out refi and get into an infinite rate of return. So like, we don't need to do some sort of complex return calculation, figure out what our IRR is. Like, we know that the place down the street just sold for 25% more. And if we can just bring this place up to that standard, it will be worth this much to any appraiser. Every appraiser is going to look at that next door comp. I mean, this total sum research, this took 5 minutes of research. So we just have to walk the asset, look for red flags, figure out, do we understand the reasons for the discount? Or is there anything that we're missing? You know, make sure we do, you know, run our numbers and check it. But it really is that simple. And when there's clarity, man, like it's so fun to take action. There's no like, you know, we want to do it. This is, you know, there's, you know, it's a convicting kind of feeling.
Yeah, absolutely. Absolutely.
We have a request to see the baby.
Yeah. He's got his little hand up on his face. He's super cute. He's 7 weeks old on Wednesday. Oh, and he's gaining weight. I took him to the doctor today for a weight check and he's good. We're happy. Yeah.
Feel free to put your questions in the chat. We've got our team here that'll capture those. We'll make sure that we answer all those questions as they come in. We've got a couple of questions. Thank you. We agree. He's adorable.
Yeah. So what we do, so we have our larger call here once a month, our community power hour. And then we also have a smaller call for the students in our single family at scale course. And that's usually a smaller group. And we really focus on, you know, what other people are seeing in their markets and the deals that they're working through and the struggles they have or the challenges or the things they want to celebrate. And we really like for that to be interactive. So we're happy to just kind of answer questions as questions come in. But we'd like to hear, does anyone have a deal that you're thinking about or a challenge that you have or something you're seeing in the market, just kind of anything? Because I find that, you know, much like anything in life, that it's the same stories repeated over and over and over. And everyone else learned so much from listening to one person's story, even if they think it doesn't apply to them. As they're listening, they figure out, you know, well, maybe I'm not in that market, but I have had that situation happen as I'm making an offer, or maybe, you know, maybe I don't have that specific dynamic with my business partner, but I have it in my marriage or whatever. There's the same stories over and over and over. So we'd love to have some interactive kind of coaching / mentoring tonight.
Yeah. I remember the first time we saw one of our mentors, Tony Robbins, do this. And we're like, how the heck is he able to figure this out? Like he seems like he must be all knowing to be able to figure out these problems so quickly. And then after seeing him do it over and over and over and over again, we realized there's not that many stories out there. And he's just seen all the stories and he's seen them 100 or 1,000 times. And so we've certainly gotten that same sort of perspective on real estate in particular. And it's neat to see the stories.
Yeah. You know? Does anyone want to go first? Anyone want to raise your digital hand or your actual hand? Or I don't know if you guys have permission to unmute yourself, but or just turn your video on and unmute yourself and ask a question.
Yeah, I think Kathy had a question there about slowdown in interest. Do you want to jump on video for a second there, Kathy?
That's probably the hot topic of the night that everyone's thinking about.
That's why I'm diving in.
Yeah.
looking for Kathy. I'm not seeing her for some reason. I don't think alphabetize these names.
All right, shall we talk about interest rates?
Sure.
Do we have a quorum for interest rates? I
suppose
thought we'd wait at least till like second or third question, but let's go.
Yeah, that's what everyone's talking about.
Let's go.
So, we've spoken about this a little bit on past calls, but the market is certainly, in a state of transition. We've seen, demand for single family and multifamily properties go down. For our part, we're pretty excited to see this shift. So we've been working our hearts out to find deals the last, year. And we basically had, tens of millions of dollars just kind of waiting here for Fund 2 on the wait list for, pretty much since Fund 1 was launched. And if we had a different structure, a different business model, we probably would have just, raised that capital and place it to get some fees, but we don't charge any fees. So unless we can figure out how to actually make money with it in a deal that we're really excited about, there's just no reason for us to place that capital. So it's been a little bit of a frustrating feeling for us to have that capital, but just struggling to find deals that we're really excited about. So I'm excited to see a shift in the market. Interest rates on the single family side for a conventional loan are, double what they were, just a few months ago. That certainly cooled things off in the market in our area. And I think this is, the case pretty much everywhere. 12 weeks ago, there'd be 20 offers on a listing. And then 6 weeks ago, there'd be 2 offers on a listing. And now there's 1. The properties are still going somewhat quickly, but
everything is still transacting same day on market.
Yeah.
For at asking or slightly over. I
Mhm.
think we've had maybe 1 under asking or 2.
We've been pretty bold.
Yeah, we have the benefit of being able to write 5 or 6 offers in a weekend,
Mhm.
right? And we're buying commodity housing. We're not like, oh, I
Yep.
have to get that one. That's the kitchen of my dreams.
Yep.
So we're able to toggle our offers and kind of chase the market down is what we're hoping to be
Yep.
able to do.
Yeah, we just wrote an offer yesterday that was 7% under asking, so a pretty aggressive offer. And they offered to come down a couple of percent, which we said no. We'll probably end up selling that house to someone else at asking price, I'm guessing. And again, we have all cash, no contingency offers, 100K non-refundable earnest money. So it's a different kind of situation. But a few months ago, we would still have to offer 10% over asking, 5 or 7% over asking. So we're seeing a big shift there. I don't see any kind of collapse. I just, there's so much liquidity out there, so much demand. There's so much more demand than there is supply, and pricing on new construction is so high. It's really hard to see a future where there's like a significant price decline. This is definitely not an 08 situation. Seems like the Fed's making the good decisions here, and I'm glad that rates are higher. They really needed to be higher. So
yeah, I think the Fed maybe acted a little too slowly.
Mhm.
I mean, that's easy for me to say. I'm not running the Federal Reserve, and hindsight is 2020. So it seems like there's perhaps a lot of unnecessary pain in the market right now that maybe wouldn't have happened if interest rates had gone up a little bit faster. Maybe they'd been able to do. I'm sorry, he's crying.
Yeah.
He's usually so.
yeah,
He's usually
last
so
call
happy. He slept the entire time.
I think he'll fall asleep soon. And,
Yeah, I just fed him, so he'll
yeah.
fall asleep soon.
Yeah.
I think maybe if they had started a little bit sooner and done, maybe 2 quarter
Mhm.
point increases instead of the quarter and then the half. And then, for those of you that don't follow, Jerome Powell, the chair of the Federal Reserve, literally anytime he can get a microphone, he talks about how he's going to raise interest rates and he's happy to raise interest rates. And he references former Fed chairman who raised interest rates and says,
He'll have a press conference where he just walks up to a microphone. He's like, I really like Chairman Volcker. He did the right thing. He made the hard decisions when that's the Fed chairman that raised to like 16%. Like, it's kind of silly to have a press conference like that's just like a silly thing for a Fed chair to get up and say. He's just trying to inject.
But yeah, hopefully that gives enough forward guidance and enough kind of wet blanket feeling to the market as a whole. I mean, obviously there's huge things with supply chain and all the liquidity that's in the market and the labor force. There's so many variables that make this, different, and not different in the sense that like pre-2008, everyone was saying, oh, this time is different. Like there will be a downturn. They always come. Things go up, things go down, and you just keep investing through it.
Yeah.
And like Nick said, be excited about when prices are going down, because that means you can acquire more real estate and acquire at a better basis. And I guess something I come back to, this wasn't quite the question, but people ask me a lot, like, is this the year to sit out? And I probably get that question, I don't know, twice a day.
Yeah.
And I've been getting it twice a day for like a decade. And it dawned on me like a week ago that the same people who said, I'm just going to wait because prices are going up are the same people that are going to say, I'm just waiting because prices are going down. There's always a reason not to invest. And there's generally always a reason to invest as long as it's the right decision, right? Maybe your strategy changes. So our strategy changes about once a quarter and always has for the last 10 years. But just carrying on and making sure that any deal makes sense at the time that it's acquired.
At the end of the day, this is getting a little bit meta, but I remember talking to Elaine about this back in like January, February, when we were like, we could raise funds too and just sit on the money, because we know that when rates go up, the stock market's going to tank. And these people, if the money is sitting in the market right now, they're going to lose 10-20% of their capital. And they're going to come out ahead just with us helping them put the money in the bank, and then the capital will be ready to go when the deal comes along. This was not some clairvoyant prediction. Like, we knew rates were going to go up, and everybody knew that the stock market was going to go down when rates went up. That's just how it works. This is not hard to predict. If you went and bought a bad deal in real estate at that time, like, you would not have lost 20% of your money the way you do with the stock market. So it's all a question of relative opportunity cost. And it's not about trying to time the market, it's trying to maximize your time in market, just owning that cash flowing property as long as you possibly can. And that's all there is to it.
One of the things that I want to talk about is historical interest rates. So can everyone see this graph? Interest rates from last year are still far below 2004, 2008. Can people, can I get at least a yes from someone so I know it's working? Yes. Okay. Thank you. Appreciate it. So there's more talk about rising interest rates than I have ever experienced in the almost 12 years now that we've been investing. So interest rates go up, interest rates go down. That's just part of the life cycle of the Fed trying to keep things steady, right? That's one of the mechanisms that they use to keep things steady. I think there's more talk right now because life feels very like BCAD, right? Before the pandemic and then after the pandemic, it feels very different than, with other interest rate increases and decreases that were just, I think probably the average person really had like no idea that they were happening. And now it's a big part of the social narrative really in the whole country. And I think that's probably because COVID, because, the rates were low through all of COVID. But rates have gone up before. People will ask specifically about our business model using a cash out refi to unlock equity and to keep going of, well, how do interest rates impact your business plan? And they certainly do. There's no denying that they don't. But interest rates have gone up in the course of our investing career, and people didn't ask us this last time they went up. I think, like Nick said, there's a potential that they might go higher, with what Jerome is saying every time he gets himself behind a microphone or in front of a microphone.
I love Volker. Next time he's just saying, I like the number 8.0. Don't you like the number 8? Like, he just has the silliest, it's like a stand-up comedy routine at this point.
Yeah. So those are the things. So, we started by talking about clarity and intuition and having a strong, kind of center when making decisions. And those are the things that I remind myself of, that it's always a good time to buy as long as the deal makes sense. You buy during the whole cycle. You just keep going. You just keep going. It's time in the market, not timing the market. Having faith in the fundamentals. If a business is operated well, right? And let's remember that rental real estate at the end of the day is just a business. If it's operated well, businesses can weather economic storms. That's part of the business life cycle. And it's all about getting down to the fundamentals, increasing income, decreasing expenses, having a team that's, rallied around a common mission and just, getting through that, and that you grow in times of downturn. So it's been nice for our balance sheet that we've been investing as the market has increased over the last, 10 years, but it's been constantly, every quarter, every year is stronger and stronger headwinds. We have to get better at our game. We have to get better at our offers. We have to get better at how we deploy our capital. And it's going to be nice for a while to maybe buy something on sale. And I don't even know that it's coming this year. I think that stuff on sale is like 2023, 2024. I don't have any sense that the market is going to crash or collapse. Like those words just, I'm like, come on, guys. Like you have to, you just have to understand fundamentals of supply and demand. Do I think there might be a price softening? Yes. I think a lot of people are expecting that value of real estate will go up, but not as much. And let's remember that the historical average of appreciation is only 4%. So when we write our pro formas, we write our pro formas at 4%. And over the last several years, people have said, well, appreciation is 10%. We're like, that's not how we write our pro formas. We write it based off of a 100-year average. If we get more than that, great. Let's go to the bank and refi faster. That's awesome. If we get less than that, we know that over decades, it's likely to come out to be 4%. And that's what I think might happen this year is maybe a 4 or 6% appreciation, which in any given year would be like a staggering amount, but we're coming off of this like heyday of 10%, 15%, 30% appreciation. And all of a sudden, like that 4% doesn't look very good. I don't see a negative for at least another year. So that's my prediction.
Yeah. I mean, in our area, it has, the cost of building a new home has gone up by $100,000 in the last 12 months. So it used to be that you could build a home in our area for like $400,000, and now it costs $500,000 to build a single family home. So until that cost comes down, like there's been a permanent shift in, replacement cost. And so buying below replacement cost is one of our fundamentals. That's a Warren Buffett, Sam Zell kind of fundamental. And we know that the price of existing real estate is going to go up because the cost of replacement just went up a lot, went up 25%. And that chart, I think, is a very salient one because you can see that historically we have tended to undershoot expectations for interest rates. And in all this talk of rates, one of my favorite expressions is if you want to know how someone really feels, ask them to put money on it. So we just locked in a 25-year AM 80% LTV loan at 3.8% on a commercial note. You can still get those lower rates on some commercial notes, take some negotiation. It's a relationship business. Strangely, we are seeing commercial banks starting to discount their rates. I think because demand for lending has gone down a lot because the market is at an inflection point here. So if you're a safe bet for that bank, they really want to lend to you. We're seeing banks reach out to us, say, hey, would you like a discount on your rate? Would you like to close your loan right away? So that's just a fascinating thing to see on the commercial side. On the conventional side, rates are going up. And then we just locked a $16 million loan. And on that one, we went variable, which sounds a little crazy, I know, but our fixed rate on that loan, it's a 3-year construction loan for a phase of Stonehaven townhomes. And we could have locked it like maybe 5.25, something like that. But if we locked on a variable loan, it would 3.25, 3.25 is the start, and that's the floor. And then there's a ceiling at 6%. Sorry, my voice is not great.
You want me to pick up for you?
Yeah.
Okay. So there's a ceiling at 6%. So all we have to do is beat that average, right? So the ceiling is a huge part of it. Everyone who heard the word variable should be thinking the Stoggebergs have lost their mind. What are they doing with variable rate debt? They're crazy. So this is one of our own deals. So we do tend to be a little riskier in our own deals. But the important thing that Nick said there is we negotiated a very aggressive ceiling. So the bank offered 6.5. We kind of negotiated for several weeks and just really said, we are conservative investors. We are very conservative with our underwriting. We have to have something better than that. And it was actually after rates went up, Nick and I are like, oh man, we missed our window. Let's email the banker. Let's just, let's see what we can do. And then he emailed us and said, we can do 6. And I don't know if that was related to the rates or not. We haven't asked yet. We'll make sure everything's signed and everything before we're like, so how do we come to this agreement? But the fixed rate was
like 5.25,
5.25. That's what I thought. I just wanted to make sure. So it was 5.25. And so all we have to do is beat the average, and it's likely that we will. So even as rates go up, even if they hit 6%, they just have to hit 6% for less than half of the loan. I mean, this is getting a little quick on the estimation, but if we're at under 5 for half of the loan and over 5 for half of the loan, and we can't go higher than 6, then we're going to be okay.
Absolutely.
Good questions. What does everyone think of that? I'm curious to hear It's our Zoom channel and that sort of thing, but there's lots of experience in this room too. And we want to learn from you guys and hear what you guys are seeing in your markets or with your deals. So does anyone want to chime in and talk about what you're experiencing or what you're reading, or any thoughts? Thank you, Nalini. I appreciate it. I hope your refis are going well. That's what we've been seeing for months.
Mm-hmm.
Get your we always say get your refis.
Yeah,
but,
back in
but we were
February,
a little more
pounding the table.
insistent.
Yeah.
Hi, how are you? How's your refi doing?
Yep. Is there anything you can refi right now?
Yep.
Yeah, the refis are going fine, Elaine. We just closed on the 5, including the primary home, and we just got the checks today. So
wow.
Yeah.
Awesome. Well, that is exciting.
Yeah,
that is the best day in the real estate life cycle, is the day you get your refi check.
Mm-hmm.
Yeah, but we are in that kind of the same thing, is like things are slowing down a little bit, but not as much. So if you have 20 offers on one property before, it's like about 10 offers right now, but still negotiation wise, it's still hard. Like something opens up, it's still hard to negotiate or get the price down. It's still going on a higher rate. So at least us, we were thinking maybe sit on the cash and wait for an year, and then when market slows down. I know you guys answered that question, but that's where at least I was feeling a little comfortable, where like, okay, we saw that the 2008 2009 crash, it took 10 years for us to get the market back to the market value what we bought just one home as a primary home back then. So we were thinking maybe once recession hits, then maybe it will be a little bit more reasonable for the product that you would buy versus at a premium price, and then pay higher interest rate and then wait for the interest rates to go down. So it's just our thought, but I know you guys said like you can't time the market, right?
Yeah.
Yeah, I guess one thing I would ask is, do you have a plan for the capital until you think you can deploy it?
A couple of thoughts on that thing is, one, like since the interest rates are going higher, just split that money put it into the CDs as individual CDs, and only the one, like if something opens up, just cash that out, even though you lose that interest rate, and then but keep the rest until something really opens up on the numbers wise makes sense, and then and keep going with whatever 3%, 4% that the banks offer with the CDs is what we're thinking. That's the only thought, but yeah, really not much to put that money into anything. Please correct me if I'm wrong. I probably am wrong, but I couldn't figure out any other better option. Like, so here is the thing, right? Like if you find a property that cash flows about 8% or 7%, which is still pretty good at this market value. So, and then you're paying 6% of interest rate on getting that loan. So you're kind of like looking at 2% barely. But if you put that cash into work, maybe 3% you could get, and maybe buy the property at a decent price is what I was thinking.
My voice, oh, there it is.
There's your voice.
Elaine, I just wrote an offer on a $70 million property. We wrote an offer at 60 million. And
we went back and forth for days about, we're coming in at 60. We talked to multiple bankers. We talked to all of our coaches. We're like, we're coming in at 60. We're coming in at 60. What do we do here?
Are we going to lose credibility with the broker?
Are we going to lose credibility?
And the broker was like, well, we're going to have offers come in at, in the high 60s. And we kept going back and forth. And then we finally went and looked at some more properties after they had not just rejected our offer, but said, don't bother submitting it. And the broker said, well, I mean, most of the offers we got were at 60 million. And we would never have known that if we didn't write the offer, right? Like, our time is extremely valuable. It takes an entire day for us to go do like pretty good due diligence on a deal of this size to write a credible offer. And that's a monumental amount of our time. But we're never going to learn. We're never going to get better if we don't get the repetitions in. We're used to writing offers in the, $10-20 million range. This is a whole different, now we're up against pension funds and, retirement funds and life insurance companies and stuff. It's a totally different game. And we just have to write the offers. And you never know, we might get it. Apparently our offer was right where it should have been. And the broker, of course, didn't tell us that. The broker said, oh, it needs to be higher in order to be credible. Don't bother submitting it because he had other offers in hand at that price. So he was trying to entice a higher offer from us. So we learned an extraordinary amount from that process. And we are going to be so much better equipped for the next deal and the next deal and the next deal. And you just have to write offers. On the single family side, we're writing offers almost every single day, frequently like, below asking. We never want to write offers that have like no chance of getting accepted or make us lose credibility. But you have to write offers to get deals. And we've had to work our hearts out to get deals. So, I would be less worried about what to do with your capital in the meantime. I know that wasn't kind of the focus of where you were going with that. I apologize. It's important to have a plan for your capital. If it's going to sit on the sidelines for a while, but I think that you just have to write offers. And so, my challenge to you would be, how many deals have you analyzed? How many deals have you written offers on the last week? And if, in my opinion, if someone has not written an offer in a week, like, are they really in the market?
That's an aggressive timeline. I love it. I want to share.
Sorry.
No, I love it. I want to share my screen again. Can everyone see my paint here? My fancy dancy 1995 paint. So I'm taking this straight from Gary Keller. So one of the great fortunes that Nick and I have had this year is because our sales volume is so high at Keller Williams, we've been invited to Gary Keller's personal mastermind. And it is
one of, if not the most elite real estate mastermind in the world.
Yeah, it is really good. It's geared for more traditional real estate agents that are helping, normal buyers and sellers with retail homes that they live in. But he has an investment piece to it every time as well. And he taught me this, and I absolutely love it. So people think of the market. Wait, I didn't confirm. Can someone confirm that we can see?
Yes.
Jennifer. Okay, thank you. Appreciate it. Jennifer, we'll make sure we get to your question. Okay, so this is what people think of the market, right? And maybe if we add like a layer of sophistication, maybe we realize that it's more, kind of like this, right? Like it's not.
Oh, if you bought right there, you would have made so much money.
It's not real. I mean, this is maybe what, maybe someone with like a rudimentary understanding of the market might think, and then kind of a more sophisticated analysis. And I would posit, this is what Gary says, that this is kind of what the average person in the economy might think. They know that sometimes things are good and maybe they're getting a promotion or a raise at work. And then sometimes things are bad and, maybe they want a new car or something, but they have to wait a while or they have to skip a vacation or those sorts of things. They have some general sense that sometimes things are worse than others, but there's, kind of ups and downs. And this is what Gary says. I'm going to erase it. Ooh, I turned it white. I turned it black. There we go. Help me turn it white, Nick. Let's do a new one. There we go. Okay. So this is what Gary says, and I heard it, and it's been like life-changing. Thank you. So life-changing that I have forgotten how to use Microsoft Paint despite using it since I was like 7. Okay. So really the market is an escalator, right? You are a person on an escalator and you're carrying a yo-yo. And that is the market, my friends. And so we just have to ride the escalator.
Yeah.
And
get on.
We can try to catch these ups and downs. They're harder to catch than one might think. This right here is called never catch a falling knife, where you're riding the wave down. But this is a 10-year hold period. That's what Gary says, is if you can hold for 10 years, which is a big part of the reason why we advocate for a buy and hold mentality. If you can hold for 10 years, you're going to have these ups and downs, but you'll be higher up. And Gary drew it better because mine's technically like a you're higher up at the end than you are at the beginning, even after you've weathered all of these ups and downs. And this was just like really life-changing for me. I just learned that like a few weeks ago. And I just like see it in my head as we're writing offers, as we're talking through things, as we're, thinking about what the Fed is going to do and what impacts there are with supply chain and new construction and everything. I just have this deep sense that we're on an escalator, and we just have to stay on the escalator and know that it's a yo-yo on an escalator. So that can kind of help you drill that into your subconscious. You're a yo-yo on an escalator, and you care much less about the yo-yo and much more about the escalator.
You just got to get as much capital, as much assets as you can on that escalator as early in the game as possible.
Yeah. So, I think prices might not go down for a year or 18 months.
At least 6 months.
Yeah. And I like that you're thinking about like a CD, at least earning a little bit of interest rate. You're, kind of quasi liquid. You mentioned that there's a penalty for pulling the capital out, but not that much. But how much earning power does your capital erode over the next year or 18 months? And if maybe we're here, I'll change a different color. Maybe we're here. It's probably where I think we are.
Yep, that's right. Where we are. Absolutely.
And you want to try to buy here, but what if you accidentally buy here? Are you really like that much different, but then your capital has lost value in the meantime? These are the things that we think about as we're kind of continually placing capital. What do you think about that? I saw you unmuted, but we can't hear you. Oh, now you're muted again. Oh, please show us your screen. Sorry. There we go. Sorry about that, guys. So I was saying, maybe we're here and I did this red, and Nalini's trying to buy when we're here, but what if she accidentally buys here? Because it's really hard to time this, right? And unless you're like constantly, like every single day in the market, the chances of missing it are pretty good. So maybe you buy here or here, but you don't really hit the nadir. So how much real difference is there? Probably not that much, but then the value of the capital has gone down, especially in such a time of high inflation. So just kind of wanted to talk through that. Sorry, I wasn't sharing my screen there, you guys.
That's my fault.
Any thoughts there, Nalini, or on how something like that might impact your strategy? Are you still with us?
Yeah, I lost her face there. One other thing I'll note is that we are potentially.
Oh, there you are. Uh-oh, maybe your connection's poor or something.
Okay. Sorry. Yeah, I was taking the kid to the swim class. Sorry.
Oh, yep, kid night. Well, hopefully this was educational for you and for others. I'm really excited about your cash out refi. Think about the strategy of letting your capital sit for a couple of years. Okay. Well, it's a shame we can't kind of quite make out exactly what you're saying, but again, I'm excited about your refi. So for those of you that know, we've been communicating about her refis for probably 6 weeks or so, kind of going through the process of getting a commercial loan, doing the credibility with commercial lenders, just all of the fun stuff that leads to this victorious day of cash out refi. So if you're able to join us after, it sounded like maybe taking kids too, and I couldn't quite catch it, but maybe soccer or whatever. If you're able to join us again later, feel free to chime in. All right.
One other thing I'll call out is that we're really focused on the real estate sector here, but it's the largest sector of the economy, but it's not the only sector. We need to buy some maintenance vans for our maintenance team. And I was just at the dealership today, and it's a 3 to 8 month lead time to get a basic cargo van, to get a basic vehicle. It's hard for me to wrap my, some vehicles, it's over a year wait time. We're doing construction, and the main service gear for an apartment building right now is over a 1 year lead time to get like the electrical mains and meters and stuff. At some point, that's going to get fixed. And there will be this explosion of economic activity that's a result of that. Like how much economic activity is not happening right now because a contractor cannot get a work van, literally cannot get a van to get his people to a job site.
Or hers.
Hers, yes.
Thank you.
We're putting in all new flooring in an entire level of an apartment building today. And I went and just checked on the job site for a few minutes. It was a circus. And there were the most interesting armada of vehicles there. There was an old unconverted conversion van. So like a 1980s Chevy 1-ton conversion van that they had like ripped all the seats and curtains and beds out of so that they could put old carpet in it that they're ripping out of our building. There were some minivans. There were some very rusty, probably pulled out of salvage yard vans. Like when I see this picture on a job site, it's hard for me to imagine a recession in the future because all this inflation stuff is not being caused by interest rates. It's being caused by supply chain. And I'm seeing this restrained economic activity.
When Nick and I get a little delirious in the middle of the night feeding the baby, we're like, Jerome needs to go unload some shipping containers, not get behind a microphone.
Exactly
Need to get
right.
him some work gloves.
That's exactly right. So it's hard for me to see.
It's only 7:42 and I got my first Jerome joke in of the day.
It's hard for me to see that conversion van that they've like gutted all the luxury finishes out of to convert it into a work van and think that there's truly a recession on the horizon. Like there is the US economy is this loaded spring that's just waiting to explode. There is so much pent up demand and capital and activity. And yeah, interest rates need to be high so that doesn't cause chaos when it finally
And
does get
social
unleashed
unrest.
and social unrest. But it is I hope that makes sense to everyone that when I go to a job site, that's what I see. I'm like, there is a lot of potential here that's about to be unleashed.
Awesome.
Yeah.
Good question. Nalini, if you can hear us, I saw your question here about your commercial property. If you're able to jump back in later, we'd love to answer that. Okay.
I can hear you, Lynn.
Oh, awesome. Do you want to talk about your question? Your other question?
Yeah, so it's on the Bluetooth. If the connection is not good, just let me know and then someone figure it out. But so it's a commercial property co-owned by probably two physicians when they first bought it. One is a dentist and the other person is currently 80 years and he wants to sell his portion of it. He currently rented it to like a salon or some beauty business, and they have another 4 more years of triple net lease on it. But the issue with that is, I think the cap rate is coming about 7% with what they're asking. But then the part that this seller, the co-owner wants to sell has to be condominialized. It's what they said, like otherwise, because it's a common area and everything under one roof. So the realtor, our realtor was like, maybe we need to check with the city, and it is going to be a long process, but long term, if the other seller also like the other owner who's a dentist, if he wants to sell it, then it probably will be better for you guys. Like you could get the whole building later down the road. Right now it's a triple net lease and they're paying the rent, so it might be a good option.
And are you wanting to acquire this portion of the commercial property for your own use, or simply as an investment and you would rent it to someone else?
Yeah, because that is already occupied by the tenants, and those tenant leases for another 4 more years. So it will be an investment purposes for the loan. Yeah.
Okay, got it. I'm gonna kind of restate some of that for people that maybe couldn't quite hear some of the words or don't know what some of those words mean. So this is a really interesting question. So and Nalini, feel free to chime in if I'm summarizing anything wrong. So she has been brought a potential commercial property for investment. It sounds like there's 2, we'll call them tenants in the building. there's two owners of the building. One owner, owner one, wants to sell, but has a tenant that has 4 years left on the lease. Owner two is a dentist and doesn't want to sell, wants to continue operating his or her dental practice there. So the question is, should I turn the building into a condo, which means splitting it so that it's two legal parcels, so that there can be two separate legal owners, just like a condominium building, right? As opposed to an apartment building where there's one owner and people just rent the various apartments. A condo, there's many owners and they have a condo association. So the question is, what do we think about the strategy of splitting that building into a condo to buy the unit from owner one and then operating it simply as an investment, a way to generate income from the lease? And I honed in on the question of, does she want the building to operate out of? She said, this is I also run a dental practice and this is the best place in town to run a dental practice. That would be a very different situation than I want to split it so I can buy half of it so that I can operate it as an investment property. So that's the question that we're going to answer. That's an interesting question. Very different than kind of what we usually get. It's outside of residential real estate. I have a pretty clear answer in my mind. What do you think?
Faith in the fundamentals. So are you creating value by condominiumizing the building? I can tell you that from a current real estate fashion perspective, you're creating huge value by condominiumizing the building. It used to be that having a 10,000 square foot per level or per space office or commercial professional services space, that was like an amazing thing. The bigger the space, the better. Today, smaller is better. Those are the spaces that are really, really excelling in the post-COVID world. People want smaller office and professional services spaces. And you are probably adding value by condominiumizing the building. I would not get hung up so much on the idea of like, we need to condominiumize it in order to do the deal. It's going to cost you maybe $10,000 to $30,000 to condominiumize the building. And I'm going to guess that you will add more than that amount of money and value. So that's a way that you add value. And that's what Elaine and I are always looking at is, are you creating value or are you just jumping through some hoops to kind of make a deal work basically? So I can tell you in terms of current market trends, you're almost certainly creating value. And I didn't hear anything in that story that sounded like a red flag to me. If you're buying it for investment purposes, is there a tenant lined up for the new space?
For someone's in it for 4 more years.
No, the other space.
The other space is a dentist.
Oh, okay. Now I got
right. Did I hear all that right?
Correct.
I feel like I'm on like a hearing test contest.
And here's the thing I love the most. Okay. And this is like, if you don't take anything away from this conversation other than this moment, Nalini, you have a comparative advantage in owning that space because you're in the business. As the landlord, you can go to the tenant and say, listen, I am in your trade. I know your struggles. Be my tenant. I'm going to be a good landlord to you for that reason. You have a comparative advantage. If this was like a light industrial space and there was a, some warehouse operation there that you had no comparative advantage in investing in, I would be much less interested in this deal. But the fact that this is a medical professional building and you're a medical professional like that, those are the kinds of comparative advantages that everyone needs to be looking for in every deal that they do. And I don't hear people talk about that enough. They're like, oh, I want to go to this market because it's got good cap rates. Who cares? You should only invest in things where you have a relationship, a breadth of experience. You have, Warren Buffett calls your sphere of competence. I suspect that you will have, some competitive advantage in managing that space and condominiumizing it because of your personal background.
Got it. Thank you so much. Yeah.
Go for it. Get a good
And you got some money.
And you got some your asset will have a baby asset. I love it. Get a good real estate attorney and make it happen. Good question. Thank you.
Perfect. Thank you so much, guys.
All right. Oh, don't want to do that. Okay. Mark asked about our higher rates. Mark, you want to come on and spotlight? Can I find you and put you in the spotlight? I'll wait for your consent. Is that good?
Sure. Hi there.
How are you doing?
Good. How are you?
Good. We miss seeing you, Mark.
Yeah.
Hoping to make it out there in July. We're working on the travel
Everyone should come
plans
out.
now.
July 15 to 17, we're having our conference.
Mark's going to be
It's going
there.
to be a blast.
Yes, it is going to be a blast. The baby's going to be there. Okay, so Mark's question is, will higher rates make refinancing a bigger challenge with your strategy? On the multifamily properties, what kind of debt service cover ratios will be allowed by the commercial lenders?
Wait, why'd you put him on spotlight if you're going to read the?
I just wanted to help him out. I wanted to get started here. Anything else you want to add to that question, Mark?
Right. So with the strategy that you use, it's so attractive when all the capital comes back. So then you have that infinite rate of return. So our investment has been rising in value. So we're really interested in getting to that point of that refinance where we get our capital back. Of course, then I'll have to deploy that capital, which is a little bit of pressure, but
Good problem to have.
good problem to have. And the returns on the property itself go up so much. So I'm interested in getting to that point. So just trying to learn as much as I can about how this rising interest rate environment makes that a more challenging event.
Yep,
Yeah.
absolutely. Yep.
Well, it certainly does, right? There's no denying that when money is more expensive, it makes it harder to get the money out of a deal. And it, depending on what sort of debt is used, let's say there's debt on a property at 2%, and then we can't refi it until debt is at 8%, right? That's a huge difference that increases the amount of debt service that we have every month, which then decreases the cash flow. But if we're getting enough of the capital out and we're pushing toward a zero in the denominator, that makes the price of the money much less important. It's still important, but it's much less important. I think that needs to be the mission of my life for the next month or two, is to write an algorithm for this, right? Like there's like an inflection point at which point the cost of the money, like until then, the cost of the money doesn't matter because you're getting closer and closer to zero, which then gets to an infinite rate of return. And some of the fundamentals that I think about are, number one, can the original asset still cash flow? That's very important. Number two, is there enough money coming out of the deal that something can be done with it that's useful? And useful to me means buying another cash flowing asset. If it's like, let's say in like a single family home, if it's like 10 or 20,000, that's probably not worth it because of the time and the complexity and the risk. And then just knowing human behavior, that money's probably going to be wasted. Versus if it's like 60,000 or 80,000 that's coming out, and that's enough to go buy another single family home in that person's market. I think the kind of a typical investor like that we work with would be very motivated to take that 60,000 and spend it on another house, whereas maybe the 10,000 kind of accidentally gets spent on a vacation. So those are kind of the two fundamentals that I look at. And then to some extent, once the money comes out and you still own the first asset that's cash flowing, I mean, I will go to great lengths to get the money out to be able to buy the next asset because we're getting to that infinite rate of return. And like we said with that curve, like we have done this in periods of rising interest rates before. It's certainly harder, but it's not impossible. And typically interest rates rise somewhat slowly. Right now they're going up at like a faster pace than I've seen before, but it's not unknown that this is happening, right? The rhetoric for a while has been interest rates are going to go up, interest rates are going to go up. So that gave us a long window to say, let's get our refis, let's go. Conversely, what could happen, which doesn't happen because it would be the opposite of what economists want, is surprise interest rates are going up, right? That would be the opposite of what economists want for human behavior in the system. So and that's a big part of the reason why we try to look for deals that we can move very quickly. So for people that have heard about our deals, or when we coach other people on their deals, you'll notice that we never say, well, we're going to buy this building and refi it in 10 years. Because there's just too many variables in between there. And interest rates could be really up, they could be down. I mean, kind of who knows where they are. But we're really targeting like a 3-year time frame, and really the shorter the better, because you can generally predict where interest rates might be in that shorter window. not to like, at least I don't feel like I have the ability to predict them to like the percentage, but I can predict like, are they going to be up or are they going to be down? For the most part, COVID kind of threw things for a while. But the faster you can do it, the easier it is, because then you come in at say 3.5, maybe you're coming out at 5, but you're not going in at like 3.5 and coming out at 8. Those are some of the things that I think about.
Mhm.
What do you think?
So strategically, I don't think I can add anything to that. Tactically, so you're talking, I think, Mark, you're talking about a situation which is called being debt service constrained versus value constrained. So we've added value to the property. So when interest rates have gone down and the market is going up, we struggle to get the appraisal value that we need in order to successfully refi. We've got tons of debt service coverage ratio, but we just can't convince the appraiser that we've made the property that much more valuable in such a short amount of time. And pretty soon, it's going to be the opposite, where there's going to be all this historical data that says the value is super high, even if maybe the value is a little lower today. But now we are potentially debt service constrained because the cost of the debt to refi limits our loan proceeds. So maybe we can only get a 75% or 70% LTV loan on the asset. So the nice thing is that interest rates, as Elaine said, are slow moving. So we want to act quickly to refi and then just kind of hang out for a while. So, if it's possible, we're going to get a second loan, we'll keep our existing financing in place, get a second commercial note, and that will blend those interest rates and ease our debt service constraint. Banks are usually okay with doing that. They're not excited about it, but they'll do it for good customers. And then we're going to look at different ways to strategize that cash out refi. Can we maybe bundle in a set of improvements to that refi that would let us hit some future target rental rate? Now that's playing with fire a little bit, and some people I think have done that a little too much. We don't do that very much, but that's something I feel very good about doing. If this is literally just a question of making the numbers look good for the bank, when we know the asset's going to deliver financially, and we just have to hit a certain 1.2 or whatever debt service coverage ratio for the bank. It's got a little bit technically complex. So, everyone else on the call, basically your debt service coverage ratio, the bank just looks at the debt service, your monthly payment, and the income, the net operating income for that asset. And you typically need to have like 1.2 times your debt service in net operating income. So the bank insists that you have a margin of profit, a margin of safety to make sure you can make your mortgage payment. A lot of lenders want like 1.3 or 1.25. We're usually able to negotiate a 1.2 or maybe even a 1.15 because banks know that we're such good operators. So banks that we have a relationship with, sometimes they'll even go down to like 1.1 or 1.05. If it's a value add deal and they've seen over and over and over again that we add value, the rents tend to go up, the property gets nicer, so they're going to be in a safe situation. So we don't tend to be debt service constrained compared to many other operators. If you look at that $70 million deal that we wrote an offer on, you could be debt service constrained to a 50% LTV loan on that deal. Because for various reasons. So that's just to say that a lot of operators are extremely debt service constrained. And because of the kind of unique business model that Elaine and I have, we tend to suffer from that a little bit less than most. So just depending on, if you're in California, like you're going to be very debt service constrained. Or if you're, doing a deal that for whatever reason is just not cash flowing very well. We're doing a deal right now that is debt service constrained. I guess I can't share details about it, but we are purchasing a prominent landmark.
Oh, yeah.
It's terrazzo floors and marble wainscoting, and it's 100 years old, and it's the most beautiful, cool building ever. But it doesn't make a ton of money. I mean, it's a building where I might put up my office because it's just the coolest building, and it has like significant historical significance. Now, it's not a vanity piece. It does make money. And it's worth a lot of money because it has a lot of sticks and bricks. Heck, we're paying a price where the dirt that it sits on is almost worth the price we're paying. And we're getting the terrazzo floors for free. And the Art Deco construction and just like this building is so cool.
You're like giving it away. Like someone's going to be able to we don't live in a very big town, Nick.
That's true, yeah. So yeah, we're literally buying like one of the most prominent landmarks in town. That's a debt service constrained deal. And so we're going to have to work through that. I've got a strategy that we've put in place to kind of cope with that. But out of the box, I would probably be eligible for like a 50% LTV loan. because it's really
And it's
valuable.
poorly operated.
Yep. That's certainly a piece of the puzzle as well, as is frequently the case for us. So it's super valuable. Like any, naive person could just walk by it on the street and say, that building's worth a ton of money, but because it's functionally obsolescent, it doesn't produce a ton of income. So it's valuable and it will appreciate in value probably a lot, the same way like a fine piece of art or something appreciates in value. But you have to make sure that you can, get a good loan on it to get a good return on investment. So these are all the different kind of levers that we need to turn in an escalating, escalating interest rate environment. I guess I'll conclude by saying it's not as bad as some people think it is, so like at the best of times we were getting 3.25%. And that's like some of the best debt we ever got was 3.25%. We just locked in 3.8%. We're only off by half a point there. And our floating rate debt that we just locked in with the 6-point ceiling, that's the floor on that's 3.25%. So like, and rates will go up and it will get worse. It might get up to 5.5%, 6% or something like that. But for the moment, everyone on this call, if
you haven't gotten your refi yet, go get your refi. Yeah. Go get your refi. You still have some window.
Yeah.
So Nick, one more follow-up question on commercial loans. So there's the T3 and the T12, which is the historical performance of the asset. Is it true that commercial banks look at T3 for revenue and T12 for expenses?
Yes.
Yeah, I would say so. I would say our experience has been there's no real standard, and it's all about what that particular banker likes, what they have had success with in their career, what has burned them before in their career. They're going to look for those things, kind of same as us as physicians. We see a bad case of X, and even though we know we're probably not going to see it again in our lifetime, we think about it every time we see kind of a similar presentation. And then I find that the narrative matters a lot. So it's not uncommon for us to have, a pretty kind of skeleton package that we'll send to bankers. That's what we talk to people about, having like a credibility deck, have your basic financials in order, maybe a couple of tax returns, a personal financial statement, and then send that. And every banker will ask for a different set of, okay, I really like this, but can you send me the T12? Or I really like this, but do you have, have you talked to the county assessor about where taxes are going? Like, it's kind of hard to predict what might come, but in general, what you said about the T3 for revenue and T12 for expenses, that's generally true. And largely that's because of property taxes and insurance, which tend to be either twice yearly or once yearly. So you can capture a T3 where you don't have any of those, and wow, your NOI looks amazing. Well, it's because the biggest expense of the year, which is taxes, isn't on there yet.
Yeah.
And the T3 can be going up significantly for a property that's going through a turnaround.
That's correct.
Yep.
Or going down if
there's
someone's
vacancy,
let their foot off the gas.
or if there's vacancy, like, right now, one of our buildings is half empty. So
50% vacant.
Because we are pushing renovations as hard as we possibly can so that we can lease those places July 1st and August 1st. If this were November, we would not push that much vacancy, right? That wouldn't make sense, because then we're going to have units ready to go in January. That doesn't make sense as much in our climate. So right now our T3 is terrible, but from like September, October, November, our T3 should look really good.
I found out our contractors got together at a bar this past weekend and got drunk and talked about how hard we make them work. And so
how hard we ask them to work.
I'm sorry we give you so much money. I don't know. It was pretty neat going to that apartment building, and there's just like a flotilla of insane cobbled together work vehicles, like just a dozen contractors, just the hum of a busy beehive of work. So yeah, that's definitely that's going to handicap our T3 on that asset. One final thing I'll say is Elaine was right. That's all relationship. So that works at small scale with a single family home. So if you find a commercial lender who believes your story, you can get a better term sheet. You just can. Like, they can, if you're doing good for the community, they will approve a 1.0 debt cover. They'll even like kick in money. The bank will find money from their charter, grant program to subsidize loans for whatever,
lower the origination, all sorts of things.
They'll do anything. And then you might think maybe that's a small ball thing. No. So I have a friend who is getting a $50 million loan right now. And the CEO of one prominent bank just drove to the office of the CEO of the other prominent bank and said, hey, here's the loan we're going to write. Do you want to split this up? And it's a, you know, it's a face-to-face 15-minute meeting. I mean, no one there is looking at a spreadsheet. Like, the borrower is of such high reputation and such high balance sheet that it doesn't matter. And the two banks are such strong banks and have done business with this person before that it doesn't matter. So they literally they probably sit down with a glass of scotch or something and just say, okay, it's going to be 80% LTV, and we'll give them a 40-year amortization. And, you know, do we need to charge interest on this loan? I guess so. Yeah, let's make it 2.5. Does that sound good? Yeah, we're going to make a ton of money on this, no matter what. They're good for it. Sounds good. And that's how the term sheet's decided. So at the low end, you know, with a single family home, it's relationship driven and subjective, just like Elaine said. And at the paragon, at the apex of it, it's also relationship driven.
Yeah. If you're listening and you're thinking, I don't have a lot of relationships with a commercial lender, or that's too challenging. So it can be very simple. So it's all about messaging who you are and why you're valuable to that community, which can be like just a few sentences in an email. On the phone is better. Face-to-face is even better. Email works just fine. A Zoom call is, you know, kind of in the middle there. When you're asking for a debt proposal, you know, just ask for what you want. So we will do kind of an introductory paragraph of who we are, what the property is, and then the last paragraph is, we are looking for this, to set the stage of kind of, that's your baseline of what you're looking for. So I always try to make sure that, you know, the stories that we're sharing are applicable to everyone, whether you have one single family home or you're writing a $50 million loan. It's not hard. Just introduce yourself. Let the banker know how you are a part of that community, how you are improving that community, why you are a good lending bet, and then speak to the terms that you want. So we will say, you know, I think we say, like, to be clear, comma, we are looking for 80% LTV, 25-year amortization, and competitive rates, and just lay it out there. And then that kind of gives them some wiggle room, because we haven't quite narrowed down every parameter that we're looking for. So we're telling them these two better happen, and then we're asking you to compete on the third one. And that's how we get the best terms. And you just send that out to, I think this weekend, when we realized we had spent all of fund one, we sent that out to
3 banks.
Three.
Three's a good number.
Yeah.
It's not more complicated than
Because
that.
more than that, and then, like, it's hard to know, like, who has what, and it's hard to, like, respond to the emails and that sort of thing.
Yep.
Yeah, I think we were going to do like 4 or 5, and then we decided to do 3 so that we didn't get overwhelmed with the communication.
You nailed it. Those who don't ask don't get. So Mark, that's a lesson that you have certainly learned. You are unafraid to ask for things, and so you get them. My builder was working on a project, and I was complaining about, you know, cash to close or whatever on the latest phase of Stonehaven. Not complaining. I said, Brett, you know, I asked the builder, is there anything that I can do to improve? Not complaining. Let me be very clear about that. And he said, well, you should have gotten 85% LTV. And I'm like, what do you mean 85% LTV? He's like, you should have gotten 85% LTV. And I was like, so how do I get that? And he said, you ask for it. And we just didn't ask for it. I'm like, that's BS. Like, no one's.
And Brad's like a generation older than us, so we have this, you know, sort of, he takes care of us.
Yeah.
But he's like, come on, guys. Like,
yeah. I mean, that's how we are with all of our mentors, all of our coaches, is like, be real with us and, like, let us know if we're screwing up. And I'm like, there's no way banks don't do that. And he's like, sure they do. Like, here's this project we're doing. They're doing 85% LTV. And I'm like, okay. And I just have to ask for it. And he's like, well, you're not going to get it if you don't ask for it. So we failed to ask for the 85% LTV. Now, I don't know what conditions went with that. You know, like, was there PMI or something on a construction loan? I don't know if that's a thing or not. I'm sure the interest rate was a little bit higher. There's some other trade-offs, and I'm very happy with the loan we got, but we didn't ask for 85% LTV. We certainly didn't ask. So just ask. Lots of good stuff here. Hopefully we got your question there, Mark.
Yeah, that was great. Thank you.
Awesome.
thanks, Mark. Good to see you. Tell Lena we said hello.
Will do.
All right. Jennifer, I saw that it said you have a question, but not sure how to raise your hand. If you're still here.
Yeah,
we'd love
hi,
to-
can you hear me?
Yeah, here, I'll put
Loud enough? Okay.
Yeah.
fine. Congratulations, Abram's beautiful.
thank you.
He has a
He's
nice head of
sleeping
hair, I
now.
see.
He does. Yep.
So I don't so much have a question as I think I just need a hug.
Okay. We do that too.
I'm just Oh, thank you. I'm just all over the place. So I'm a family doc. You're my primary care model for success, because, you know, we're not vascular surgeons, are we? We're starting with small potatoes. And so, you know, my frustration is that we're just still swimming in the kiddie pool for years, and I don't know how to get out to the next level. What do you guys call it, in the trough or in the whatever?
In the valley.
I'm in the valley. Get me out of the valley.
Valley of despair.
Yes, I'm in the valley of despair. So we retired my husband early, and for
That
fun.
doesn't
we
sound like the
decided-
valley of despair.
Yeah, well,
Valley
We
of early
retired.
retirement. Must be
we
nice.
retired
You
him
have high
early.
standards and I love it.
Thank you. We retired him early because he kept getting downsized in his industry, and he was getting like these crappy job offers. And we said, you know, we had both been interested in flipping houses, and we both sort of been reading a lot about real estate. We said, I bet we can make more in real estate than you can with this like crappy job that keeps getting downsized because your industry is disappearing. So we did that. We talked to our great contractor that we'd worked with on our own homes for years. We actually lived in 2 flips ourselves. When we first met, we flipped our first house. After 2 years, we bought another BRRR. We fixed it up. We flipped that one. Then we moved into the house we're in now. So we flipped 4 houses locally in 2017 to 2019. And so my husband was a project manager. So he wasn't really retired. He keeps reminding me that's not real retirement, but you know, he was on his own schedule, and he didn't have to work for a boss and get up at like 6 in the morning. And we did pretty well. 2 of them were like, one was a real home run, and one of them did pretty well. And 2 of them, we made like in the 20s in profits, but you know, they were pretty quick and easy flips. So not complaining, and it was fun. And these were bank-owned foreclosures that had been languishing on the market since 2008. In New Jersey. It took the court system in New Jersey like a decade to clean up the foreclosure crisis mess.
Yeah, we have one of those. It was vacant for 9 years.
Yeah. So
Crazy,
these were
isn't
too, and you know, vacant houses rot. So by the time we bought them, like the roofs were falling in, and the mold, and the, you know, just garbage. So it was really fun to fix up these houses and make them new and get someone to live in them and return them to the community. And then I don't know why, but I decided to do a long distance flip in the California desert. I had started browsing properties in the Los Angeles area because my son lived out there, and I thought, oh, maybe he can like project manage a flip for us out in California. And I happened to find a listing in Yucca Valley, which is next to Joshua Tree. And but I bought it with all cash. And I know this is one of my problems. I keep buying cash and not using leverage, and that I'm not going to make the leap, you know, to real equity growth unless I start using leverage. But I bought it cash and found a good contractor out there. And my son did do some of the work and flipped it. And COVID hit, right? We were a few weeks from finishing up the rehab, and COVID hit, and I couldn't get any contractors to go out to the house, even though they were all working there alone. Like, you know, by themselves. Like, I don't know why no one wanted to work. And by the time the rehab got delayed for a couple of months, put it on the market, and it literally, like, no one looked at it. It took 3 weeks to get an offer. I was shocked. And I was at the point where I was thinking, maybe I should just keep this as a long-term rental and like work with a local realtor, put a tenant in it. We'll own a rental. Then I'll refinance. I'll put the money back out, the cash that we used to buy it. And then I was like, no. I don't want to be a landlord. I just want to unload it. I was still in a flipping mentality. Like, you do this rehab, you put it on the market, you flip it, you take your money, you do the next one. So I couldn't wrap my head around being a landlord of something that was 3,000 miles away. Of course, I'm kicking myself now because the property's worth 100,000 more than what I sold it for like 2 years ago. So I sold it eventually, got my money back. And for some reason, after telling myself I didn't want to be a long distance landlord, I decided to become a long distance landlord and bought some small multifamily outside of Cleveland. So again, like, I'm all over the map here, right? What?
You're in New Jersey?
I'm in New Jersey.
Okay.
So I
Why
started
Cleveland?
thinking, well, I was listening to you guys a lot, you know, and your content and stuff. Actually, I was a beta tester for your course.
I remember.
Yeah. And I was, Leti and Kenji, semi-retired MD, were doing a lot of like Zoom webinars in March and April 2020 when COVID hit. They were doing like a lot of just Q&A type stuff and some little teaching type webinars. And I started to think like, okay, buy and hold. Like flipping is not where it's at. We need to buy and hold. And, you know, Nick and Elaine bought single families and duplexes, and Leti and Kenji started with duplexes. And okay, I need to set my mind for that and start doing that. And I was looking kind of in the Midwest based on just what I was reading on Bigger Pockets and stuff. I mean, I've been a pro member on Bigger Pockets for like 6-7 years, you know, before we started flipping, because we were just researching and reading about real estate and stuff. So I was like, I did all the podcasts, listened to everything. So I was looking in like Iowa, Indiana, and sort of migrated into Ohio at one point because I just felt like it was a stronger market and numbers worked and whatever. But, you know, I ended up in a town called Lorain, which is 30 miles west of Cleveland. It's right on Lake Erie. And I liked the town. It seemed to have like a nice employment base. And, you know, I felt like I did my research. So I ended up buying a package of three properties, which was one duplex and the dreaded triplexes that I know you guys don't like. So it was 8 units total, 2 triplexes and a duplex.
Are they purpose built?
Huh?
Are they purpose built?
Or chopped up single family homes?
They were chopped up. Like one was like a big old 100-year-old Victorian.
Yep.
Okay.
And then one was a craftsman with an adapted basement and then the main floor. And then the top floor, they had built like a staircase to the top second floor of a craftsman. It was quite a large house. Like the main floor had like 4 bedrooms, you know, because.
Okay. So, and when did you acquire these?
I bought them December 2020.
Okay.
For all cash. And I knew they needed work. And my plan was I would be kind of working on them, rehabbing them over 3 to 6 months. 5 of the units came with tenants, which I didn't mind because I didn't want to take on having to find tenants long distance and dealing with all that. Like it was just easier for me to feel like, okay, rent's coming in. You know, I bought them like end of November and a week later I had rent checks coming
Would
in.
you
because they
rather
already had
marry a man that you choose or marry a man that someone else chooses for you? I just made that up.
Well, that's a good analogy. No, I
like,
got lucky. Actually, the 5 tenants that were there all turned out good. It was the 3 that I placed that were really crappy and turned over twice each. So yeah.
Did you place them or did a property manager?
Well, one of them I had the broker that I bought the houses through held an open house and initially filled 2 of them that way by having an open house. And I did like Facebook ads or something. I don't remember. I mean, let me just say that it was a little too out of my control and I don't enjoy landlording.
Okay. Do you have a professional property manager?
No, I was self-managing long distance.
Got it.
Okay.
Got it.
Okay.
So, I mean, anyway, the houses are gone. I sold them last year. So it seemed like they started falling apart as soon as I bought them. So I knew the rent money was going to be going back into the houses for a while, but I mean, it was relentless, the work that was needed. It was like not a week went by without a phone call that an appliance had broken or there was a plumbing leak or a window had fallen out of its frame or on and on and on and on.
Yep.
And it was absolutely crazy making. And I am getting out of small multifamily. This is not for me, especially long distance. So the one triplex, I made a nice profit. It was the least needy of the properties. It commanded solid rents. It was in good shape. It only needed like a couple minor things during the time I owned it. And that was the first one I unloaded 8 months after I bought it. I sold it. The duplex broke even. I didn't make a profit on it. I sold it for what I bought it for.
Okay.
The other triplex I sold at a loss. So all in all,
did you make money on the whole package?
No, and all three assets, we actually lost $35,000 when we resold the following year. So that was our first real estate loss, which really stings because we were pretty good at the flip houses. It just worked for us. You know, it worked with like our skill set. And you know, I don't know,
What's your
felt
husband
so
doing these
easy.
days?
So now we have so our only assets right now, I took the money from the Ohio houses and I bought a single family home outside of Austin that,
Texas?
Yes.
Okay.
That was an incredible purchase because I bought it for 170 and we're putting about 40, 50 into it. And it's probably going to reappraise at 300. So I'm already working on the refinance on that. My tenant it turns out is actually going to be my son who has relocated from Los Angeles. So I bought the house. He wanted to move to Texas. He wanted to get out of LA, which is a horrible, horrible place to live. And his fiance is from Texas and they wanted to go back to Texas. So I bought it as kind of a carrot and said, hey, you guys can move there, fix up this place, see if you like it. And he had project managed the flip in Yucca Valley. So I knew he could project manage the flip or not the flip, but the house in Austin. And then I said, if you want to stay, you can, and you can be my tenants and pay me rent. Or you guys can move on. We can resell this. I can put a tenant in it for a long-term rental, or, you know, you guys can go find another place to live, whatever you want to do. So they love it. They're thrilled with it. They love the house. They love living where they are now in this town, and they're going to stay. So they're my tenants. And we also owned a second home in upstate New York that we bought for all cash with flip profits back in 2017, which we very, you know, bittersweet have decided to sell. We don't go up there much. It's a short-term rental. It just breaks even. It covers the cost of ownership. We never made a ton of profits on it we've used it as a short-term rental since 2019. And the area has gotten very saturated since we bought it. It's kind of, you know,
Will you make money on appreciation?
What?
Will you make money on appreciation?
Well, yeah,
selling?
this is the crazy thing. I mean, we're selling it because we knew we would get an offer we couldn't refuse. We bought it for 120 and we have an offer for 360.
Nice.
So we
Turnkey
tripled the
Airbnb
price.
for someone else to operate.
Exactly. And I think that's what someone else is going to do with it. You know,
Wonder why it's getting so saturated.
right. It's, yeah. I mean, we feel kind of mixed about it. We're actually hoping someone will buy it as their own second home and not just to rent the heck out of it. But whatever, it's, you know, won't be ours anymore. So we're letting go of that. So we have that money coming in, which I'm going to 1031 most of it. I need to keep a little chunk of it because we have some other house projects that we need to do on our own house, because we're selling our own house next year and relocating after my daughter finishes high school. But anyway, so we need to hold back a little bit of that, but the bulk of it is going to go into 1031. And I'm going to refinance the Texas house and probably pull like 160, 170 out of that in the refinance.
Okay.
And here I am at another fork in the road, except that my forks in the road are more like 5-way intersections with a clover leaf in the middle. And I have to stop buying with cash. My DTI is high. I get terrible loan terms. Terrible. I mean, my credit is low.
Do you want it to be a clover leaf?
No, I want to
to be
pick a
complicated?
lane and stay in it.
I'm glad to
And-
hear that.
Who knows what the undoing of any entrepreneur is? Has anyone come to enough of our things that they've heard that?
Throwing different stuff at the wall to see what sticks.
Yep. The undoing of an entrepreneur is getting bored with what works.
That's right.
And so my mind is like way back. I've been like, the reason I'm asking so many questions is because I'm like forcing myself to concentrate, to follow the narrative. I'm way back on, my husband was working for himself, enjoying himself, flipping some houses, and was doing well.
Yeah. Now,
Why did you stop?
The story should have stopped there.
Why did you stop? Why'd you
We
stop
we
flipping?
stopped
Then
for a
you-
very
then you
good
went to
reason, which is-
California because New Jersey was no fun anymore.
And then Cleveland.
No, we
Austin.
had to stop because the foreclosure market dried up, and what was left, a lot of contractors were buying them up and fixing them up on the weekends because they didn't care about, what profits they were making. They were putting their own time into it. And the banks also got greedy. And instead of these houses selling for pennies on the dollar, they were selling for like, near retail price. And we're like, excuse me, we were used to making an offer. We had a saying when we were flipping houses, if we're not embarrassed by our offer, it's too high. So, I mean, it's so silly what we picked up the houses for that we were flipping. I mean, we literally could throw out any price and like insultingly low prices, and the banks took it because these houses were rotting and they've been sitting on the market for a decade.
Yeah.
And
Nonetheless, it's rare for people to successfully flip. It's rare for people to do that profitably. And if you can do it once, you can do it again. Or if you can do it 4 times, you can do it again.
So what I hear is that you had a trick, right? You guys were really good at tennis, and tennis got harder, right? The rackets were covered in grease, or all of a sudden you were doing it on an ice rink instead of a tennis court. And instead of saying, I'm pretty good at tennis, I'm going to hone my tennis skills, you said, I'm going to go play football, having never played football before. That's what I heard, right? Because the market got harder for everyone. It didn't just get harder for you or just in your market. The same thing happened to us. Houses that we're paying, I don't know, $325 for today, we were paying $85,000 for like 7 years ago. And I remember the first day we're like, we're never paying over 100. Not happening. Not happening. And then I'm like, Nick, can we pay 101 for this one? And then it was 140, and then it was 160. And then, I mean, these were like, do you remember our MLS searches? Then it was 180, then it was 220, then it was 250.
Wow.
Then we were like, fuck it, let's go to 300.
Wow.
I hope nobody's children are listening. My child's listening. But so it got harder, and it got harder for everyone else that's listening right now. You had the opportunity to hone the skill instead of learning an entirely new skill.
And what's worse, because you were good at tennis, you thought you were good at football. And that can be the undoing of a lot of people. That can be the real disaster. Russia invaded Ukraine thinking that it was going to be just like Crimea, except Ukraine learned from Crimea and Russia didn't. And so very few people can successfully flip. We're not saying you should flip. I think if you can flip, you can burr. But do you think that there are people who are successfully flipping in California right now and have been successfully flipping in California this whole time?
Sure. Yeah. If that's their niche, if that's their, if they're good at making hamburgers and they're still making hamburgers, they can still make a good hamburger,
Most people
But,
get bored with what works. McDonald's is McDonald's because they didn't get bored at making hamburgers. Their hamburger isn't even that good. They've just iterated on it over and over and over again, to the point that we pull into McDonald's an embarrassing number of times because our children know that, they're going to like the chicken nugget, basically, So,
we know what it's going to taste like. We've been there before.
So it is, I would challenge you to examine whether or not you really do want it to be simple. I think most people like the idea of, I'm going to have a vacation rental and I'll have a little flip over here, and I'll have a couple of long-term rentals. Those will be the backbone of the portfolio. And, Elaine and I, we've been doing this a long time, and we've got a big portfolio, and we still stay ruthlessly focused. There's deals that hit our radar every single day, and we're like, man, that looks like a lot of fun, but we don't really know about that. It's not something that we truly know we have competence in. And in fact, it's kind of like something we have competence in, but not really. So we might even go into it a little overconfident, and that's when real damage can be done. So I don't know.
So that worked, and it sounds like he enjoyed it, because I do think that's a big piece of the puzzle. What's he doing these days?
Oh, fly fishing and complaining that I work full time and he has no one to hang out with during the day.
How old are you and how old is he?
Well, that's the other wrinkle. I'm 51 and he's 63. So
you're in a different phase.
He's bored and I'm in mid-career.
You're going to feel that pull here in the next few years in a really strong way. You're in different seasons of life. So I find when you're 55 or so, you're still excited to be in the office, but maybe don't have the same hunger that you used to. When you're 60, you're what I call out of office. you don't like being in the office anymore. You know, and I observe this like consulting with attorneys and doctors and stuff, like, you know, at different ages, like, oh, I just can't seem to reach that person anymore. He's over 60 years old. And then after 65, you're done. You want to be out. And those are very common patterns that I've observed. And so, like, it's normal, it's righteous that you are hungry and want to do some things, and he wants to be fly fishing. And that's completely normal and right. And you have to just know that those are the seasons of life that you're in.
So you have this new bucket of money. What are you going to do with it? Typically
what do you want?
Typically I ask people like, what excites you? But I don't know that that's the right question for you, because what I don't want to hear is, oh, I'm going to go to Kansas City and buy an office building because that's exciting this time. Right. So that's the question I typically ask. For you, I was steering toward, let's go back to what worked, even if you have to get better at it. It sounds like maybe that's not an option if husband is more in a relaxing phase of life than he was years ago when he was flipping, or would he be excited to do?
Well, one interesting opportunity is that my son in Austin is interested in doing some real estate, and he and I have talked about doing flips where he is, and he can be my project manager. He needs a job. He needs money. He actually, the last 2 years, was working with a contractor in Los Angeles as kind of he wasn't actually getting his hands dirty, but he was learning how to like price jobs and write up estimates and stuff for this contractor who had started as a friend, but kind of took him under his wing and like, hey, let me kind of show you how I do my business. So there's the potential for that. And then another thing, and I know this just sounds like I'm just psychotic, I'm all over the place, but seriously, if I did buy and hold, I think what I'm most interested in is mobile home parks, because I really don't think I want to deal with tenants. I just don't, it's not my thing. And I'd rather own land.
In mobile home parks?
Well, you own the land and they lease the land. So you're responsible for the water, the sewer, you know, the street lights and the driveway. And they're just leasing a lot from you that they've parked their mobile home on for, 30 years.
Would you own the entire community?
Yeah, you own the mobile home park.
Okay.
But all the people you don't own the home. You're not responsible for anything under that roof.
But you own the behavior. Let's be clear. You own the behavior.
I know.
You own the guy on the other side of the street in the blue trailer looked at me funny yesterday. What are you going to do about it? Or someone's playing their music loud, or someone's drives their car fast,
all night long.
Someone's dog is cuter than my dog.
What I hear is that you have the ability to find deals and to get deals, and you have the ability to run rehabs. Those are rare and valuable skills, and you should do something that leverages those skills, and you should not stray from that. That's what I hear. I could be wrong about that.
I hear that you have cash, and you said several times, at least twice, I shouldn't be buying in cash. I don't get that. You should absolutely be buying in cash. It's how you get the deal. It's how you get, a little bit of a haircut on the deal. Why do you think you shouldn't be buying in cash?
Because it's limiting how large I can go. Because
I see. Okay.
I'm not using leverage.
Okay. So I honed in on cash. Nick honed in on, it sounds like you can rehab. I don't want to dig too much into the son thing. Part of me is excited that he's going to be your resident, and then also potentially your project manager and your son. Part of me is like, oh, make sure you guys have some really clear boundaries. Make sure there's a real lease, a real employment contract, whatever needs to happen.
You're also ineligible for the tax benefits.
Technically, if they had a market rate lease, you'd need to talk to your CPA. But technically, if you're renting at a non-arm's length transaction, that does drastically limit your tax benefits. I think if you had a market rate lease and could prove that it was a market rate lease, you'll need to talk to a CPA about that.
Right.
But I never want anyone to damage very special relationships because of real estate. So it makes me a little weary that that your son is a big part of the plan. But I hear that you have cash, and I hear that you can flip. I don't think that recommending flipping in May of 2022 is a wise strategy, right? We spent the first part of the call talking about the fact that prices are at at best likely not appreciating as quickly, right? So you don't get some of
Yeah.
that tailwind that you can get with a flip, say 3 or 4 years ago, where yes, maybe someone came in and really truly added value, but then they got a little extra boost just from the market itself.
Yeah.
And you keep coming back to that you don't like tenants or don't want to manage tenants. Hire someone to manage tenants for you. I don't like tenants whatsoever.
She
Like,
hired me.
I hired Nick and then we hired a team, and
I love tenants.
we literally have a joke in our office that if Elaine knows a resident's names, watch out, because that means that there's been some level of too
Wow.
much
Drama.
I was going to say, we'll call it drama. And that, you know, in my mind, I think that comes from my background as a psychiatrist, that I'm all about boundaries and expectations and
Yeah.
standards of behavior. And you're right that sometimes you don't get that as a property manager, or as a landlord. 98% of people are lovely, pay their rent, report maintenance tickets when they're supposed to, take great care of the
Right.
place, and like we have like a whole wall of thank you cards that they send when they leave. That 2% for some people,
We do actually
Yeah.
have a
Just-
whole wall of thank you cards.
yeah, there they are.
A bunch of them fell on the ground.
Aw.
But that 2% does make it a drag for some people. And it sounds like, you know, you're in that camp. I think I'm in that camp. But I know that,
Well,
go ahead.
I'm also the kind of person with the short-term rentals who is living in constant fear of someone trashing my house and gets really upset when like the dining room table got a scratch in it. Do you know what I mean? Like
Mhm.
it's
Like a sense of
tenants-
hypervigilance. Yeah.
It's anyway, it's me giving up control, right? I'm like a micromanaging control freak. So whether it's a tenant living in a long-term rental of mine or someone staying for a weekend in my short-term rental, and thank you for saying that, because you just made this materialize in my head. Like I never thought of it this way before, but maybe I just don't like people. Whether
No,
they're-
I don't want that to be your conclusion.
whether they're
Like, I gave you
whether
a
they're
hug.
short-term renters or long-term renters, I don't want to deal with them. And
And
I mean,
that's okay, right? That's totally okay.
yeah,
Someone does not have to like every part of any investment or any business, or I mean, really anything, right? Like I don't think anyone loves everything about their spouse. I love everything about mine. Not really, but, right? Like that doesn't mean that I love Nick less, right? It means that I love him a great deal. The relationship as a whole is worth it. There's some things I don't like. That doesn't mean I'm going to get rid of all of it, right? So for you,
right.
that sounds like the management piece. But I hear that you have cash. I hear that you have some skills flipping. I don't necessarily recommend true flipping, but I do recommend buying properties, renovating them, and then managing them as long-term rentals. And then you can pull your cash out, and then you're in that period of infinite
Sure.
rate of return.
Yeah.
If you do that a few times, you're going to recycle that bucket of capital. And I think more importantly for you, really get into a groove. And if you do that for the next 5 to 10 years, even with some challenges that might come in the market over that time period, you'll be set. And so you have some building blocks that can propel you to success. You know, of course, you're going to hear from us, do a cash out refi and do long-term rental, right? Like
Right.
the very first thing I'm like, flipping, why didn't you just hold them and keep them as rentals? And, you know, why'd you go across the country? And then why'd you do short-term? Like, of course, we're going to say that, you know, that's the strategy, but you have some of those building blocks. And for you, you need to make it boring. You need to,
Yeah.
for many people, you know, we're like, how do you get fired up about real estate? How do you get excited about this? And you need to be reading these blogs and listening to these podcasts and getting your spouse on board and almost like brainwashing yourself to get excited about this. And the stock market's too boring for you, right? That's the opposite advice for you. For
Mhm.
you, let's make this boring. Let's make
Yeah.
this, you're going to get a pipeline, you're going to take your cash, you're going to buy something. Maybe it's in Austin and your son's involved as the project manager. Maybe it's right back there in New Jersey and your husband gets involved more, you know, whatever. Maybe it's in both places, but you get a pipeline and you just keep that capital moving, keep building relationships, keep building that expertise, keep them, cash them out, have someone else do the property management, and tell that person, I am hiring you so that I don't have to think about this. Do not let me call you more than once a month, right? Help them
Yeah.
help you so that you're not stuck in that feeling of, well, what if my refrigerator's getting scratched? I remember this huge breakthrough. We had probably, my memory's a little fuzzy, but we had maybe 40 properties that we owned ourselves. And I swear there was an appliance every single week. Do you remember
Yeah.
this? Every single
Yep.
week.
Yep.
We
And
were like filing warranty claims with the manufacturer. And
yeah,
trying to figure out if the tenants breaking them. or what's
yeah,
going
like
on.
what's going on? Like, are people like scamming us because they want new appliances? Like, and you know, every
Right.
time was basically like $1,000. So it's like $1,000 a pop.
Yep.
And I remember sitting in the car with you. We were in Alton Hills, and I was like, Nick, I just like, we need to just quit. We need to just like stop doing this. Like, I am sick to my
Wow.
stomach every time we get a phone call, every time. So we had property management software. Every time I get a text message,
Mhm.
it's like ruining my day. I can't spend
Yep.
time with the kids because I'm thinking about these damn appliances. It's $1,000 a time. And my memory's a little fuzzy. I remember more about how you made me feel than what you said, but you said something like, how much rent are we making, you know, per week or whatever? And I kind of calculated it up, and it was tens of thousands of dollars per week. Okay, we're spending $1,000 per week on an appliance. Why are we worried about this? And if we stop, because Nick and I have always been very like, it's mostly me, but I'm like, that's it, we're done. And Nick's like, if you want to, and he's like, if we stop, like this is what we have forever. Or you can just never think about appliances again. And I promise you, I'll take care of it. And let's see what can happen. And I remember like, I was like almost sobbing. I was like tears in my eyes of like, can we do that? Like, can I like overcome this self-created barrier to growth? Right.
And you very
Yeah.
much you wanted control and you wanted visibility, even though that was giving you pain.
And I had all these like emotional stories that weren't true. Like, their appliances aren't broke, they just want new ones. And I want you to go over to their house and wash our clothes in it. And like, just all this like shit, right? Like literal,
Yeah.
like literal shit stories in my head.
Right.
And I had to surrender that. And I had to say, this is a barrier to my growth. And like, now I'm like sort of horrified that I'm sharing this in public, and then also very amused that like, this was like small ball, but at the time this was huge
Yeah.
to me. It ate at my consciousness. And that's what I hear for you. I see myself sitting in that car years ago with Nick and saying, I want to quit because this is like bogging me. This is bugging me too much. And now I don't even know how many appliances we bought in the last year, probably hundreds. I don't even care. I hope that every single one of our rental properties has the best appliances in all of Rochester in them, and everybody's clothes are crystal clean and super dry, and their stoves are amazing. Because we have so much more, because I was able to say, I can't keep doing this and still enjoy the work. And Nick has done similar things to me, right? Of, you need to handle these things. This really drags my energy.
Yep.
So you've got some really key competencies, you've got some resources, you have some cash, and then you've got to let this thing go. And then you just need to build a pipeline and get into that groove.
Mhm.
Yeah. That just provided so much clarity to me. Thank you so much. Because it's really sort of about focusing, like you said, on competencies and
Yep.
abilities, you know, where I'm at, what holes there are in my knowledge and expertise, and let that drive the direction that I go in, rather than, you know, trying to create a buffet, just make a good hamburger.
Exactly.
And like do this,
That's
do that
exactly
over
right.
and over
Right.
again.
Yep.
Yeah.
Absolutely.
Yep. And there are people out there that love to do what you hate to do. That's something I've had to learn as an entrepreneur. Like I'm like, why would anyone want to do bookkeeping? Like, I would rather die than do bookkeeping.
Yeah,
I know.
sure.
And it took me forever. Like, I would like be thinking like, no one's going to want to do this. And I'm like an evil person for hiring someone to do this. And then I realized like, there are people that wake up in the morning and just want to do books, that are just excited to categorize transactions. There is someone out there, I promise you, there's someone out there that loves to do property management, that loves to work with residents, that loves to do lease showings and screenings and manage those maintenance tickets. Nick loves it. Many people on our team love it. There's some on our team that don't love it, and they do more kind of back office-y stuff like I do. But I promise you that person is out there. and they are excited to find you because you provide them value by providing them employment. Even if they're not, your employee, you're hiring them, you provide their business income, you provide them opportunity in their life, and they provide you opportunity in your life to let go of the things that you don't want to do so that you can grow. And the more of those relationships that you find, the better you are, but the better the whole world is.
Mhm.
And when the world gets better, you get better.
Yep.
That's like a
Yeah.
law of the universe, right? The universe wants you to make it a better place. And so when you make it a better place, you tend to benefit from that. So you just have to find that property manager that's a
Right.
partner with you that wants to manage. And you get a tip-top shape property ready to go for them, and you hand it off to them, and they're happy and they take it from there. And
Yeah.
maybe you check in with them once a quarter, and it's going to be
Right.
really hard that first quarter. You're going to wonder, are there maintenance tickets, or is something being broken? Or, I'll say in 600 units in 10 years, we've had maybe 2 of this, like, tenants trashed my place. Like,
Mm,
does it happen? Yes. Does it happen at the level that people talk about it? Not in our experience. It's not in our experience. If
Right.
you do good screening and you take good care of people and you take good care of the place, most people are really good people. You've got to, like, let that go so that you can grow.
Mhm.
yeah. And like with what you're saying, I really only need to find one good property manager. I don't need to find like 40 good tenants on my own. I just
That's
need
right.
to find the one property manager that I can hand off all the stuff that I dislike to.
Mhm.
You could even build a whole business around it. We have built
Yeah.
a whole business around finding one really good contractor, and it's a who, not a how, and that's how we do everything that we do.
Yeah, yeah. Wow. Thank you so much. I'm so appreciative of that. That was priceless. Thank you.
Good.
Absolutely.
I hope it helps. Best of luck. Check back with
I'll
us
let
in a
you
few
know.
months.
I'll let you
please
know
do.
which off ramp I take off the Cloverleaf.
Love it.
Yep. Just get on a straight super highway there.
Yeah, absolutely.
Love it. Thank you.
I think we have maybe one more question there.
All right. Let's see what we have.
Vincent Wynn.
Vincent asked a question about our fund. He said, I must have gotten in a few minutes late. Fund 1 is fully deployed and Fund 2 is coming out sooner than expected. Yes and no. So the capital in Fund 1 is completely spent. We now need to lever those single family homes and then re-spend it. But everything is under contract that will spend it. Nick and I talk in shorthand because we just move so quickly, but I want to be really careful there. So we have everything under contract that's going to spend all of the cash in Fund 1, then we'll lever those properties and do it again. And then Fund 2, we have, kind of thought maybe we'd launch it right before Memorial Day, right after, and we set the date that we're definitely going to launch that June 6th.
Yep.
So those are some exciting things that are coming up, Vincent.
And Kathy asked, what's it looking like for us on the wait list? I'm not part of Fund 1. So I think Fund 2 is probably already 10% full just from our previous Tacoma investors. And then I'm not sure how many Fund 1 investors will jump in. I'm guessing they will account for a significant portion of Fund 2. So I don't know if everyone on the wait list will be able to make it into Fund 2, but we very much want them to. I think most people will be able to get in. I can tell you that Fund 1 filled up faster than we expected.
Oh, yeah.
And that I feel like
we were telling people like, oh, it'll take a couple weeks and it's around Christmas.
I feel like we
and
let people down by not
Yeah.
setting their expectations appropriately. So we're trying to, not set expectations specifically for Fund 2 in case it does, fill up very quickly. So that's where we're at with Fund 2. Yeah, excellent question, Kathy. Just stay glued to your inbox and jump in when it opens up to you.
Yeah. Holt, are you still here? You had asked a question about any tips for a new investor. We can end there if you'd like to chime in. I see you there. I just asked you to, oh,
Hello?
hi.
Hello.
Sorry. Was waiting to go to the bathroom, and then as soon as I did, you called, but my son.
Oh
was like,
man.
They're
Glad we
calling.
put you on the spot.
Well, how about I'll read your question to everyone, give you a little bit of time there, and then we can talk through it. How's that sound?
Sounds good.
Awesome. Okay, so The question is, single family homes are going so quick in our market and still going over asking price, even with a lot of work. Crazy for a new investor. Any tips?
And when I say going over, I'm talking going over a lot.
Mhm.
A
What
lot.
market are you in?
Denver.
When's the last offer you wrote?
There you are. I think
our-
last time you were cooking, you were like, I remember we like asked you a question and you were like leaning over like an Instapot and you're like,
Oh, yeah.
I was just cooking. We're always putting you on the spot.
Time. Now one kid's in the bath and one's doing some kind of project. Yeah. He's making some kind of, I don't know. Anyways, so our realtor actually has been kind of, I don't know if you want to say negative towards making offers, but then we see she kind of comes back, right? Because we're like in a price range. Like our top we want to go is 400,
Okay.
which is a lot because we are going to do, we can get enough to put the down payment down and then any like repairs, but with the cash out refinance, it's not like we're not doctors, we're teachers. And so, but often when they go for way over, like all of them. But you know, you want to
That tells
quality
you that she's
house
looking
with
at the
a
right
quality
houses.
tenant. And we're not talking like fancy homes. We're talking, she's just like, she's always like, do the numbers. You can't, it's going to go over. And they go. And then we aren't doing cash. You know, and then like, there was finally a house that was like a decent, I mean, most of them are like in the 400 range to ridiculously high. There's a house for 250 and we looked at it and someone tons of work needed on it. Immediately all cash offer for 400 and done.
So it was
before-
listed at 250 and it went for 400.
Yeah. And we, you know, I'm a
Okay.
school teacher. I like was texting her through the day and she's like, oh, it's already an offer. And you're like,
Okay. How
You know,
much do you
it's
think
just
that
like-
house was worth after renovation?
well, we didn't even get to see, but you could see there was going to be a lot of work. The comps in that area were like 450 to 5.
Okay.
That's what
So
she said.
probably someone that's going to live in it. It sounds like maybe, and they're willing to maybe do some sweat equity or slow play the renovation over years. That's what I hear when
Yeah.
someone's willing to pay that much. Is that they don't really plan to, you know, do that full renovation right away. They're just trying to get into the neighborhood. I could be completely wrong, but
There's a lot of investors in Denver that are like willing to do the flip and holds and whatever.
Mhm.
I think that there's some people with a lot of money. I don't know. Because
There's a lot
I mean,
of
a
people
lot of these
with a
homes
lot of
we're
money.
doing
Yeah.
are work homes because we're hoping that like takes out more of the people needing homes. I don't know.
Okay. So you're absolutely right. There's a lot of liquidity in the market. You know, Nick has a story about a multifamily property in Minneapolis, 127 million. And when they got to best and final, there were 5 buyers
Something
left,
like that. Or no, they were close to 10.
close to 10. Okay. Yeah, that's because I remember you said there was $1 billion. So all 10 of the buyers at 127 million could pay cash. Right. So there's $1 billion out there looking for a deal
And
and
only
only
one got it.
one of them can get the deal. Right. So then there's,
With leverage.
yeah. So then there's all this money and that's in all phases of, or all phases isn't the right word, all sizes in the market right now, all the way down to single family homes to, you know, big buildings. So, you know, what you're seeing, you're not crazy. We've been, you know, I love that we're checking in like once a month or whatever, kind of hearing. Tell me specifically, have you written any offers?
So we've done a couple offers, and we were like nowhere close to
Okay.
getting
Okay.
it. I mean, maybe we've had this realtor. She has some rentals, but that's not her primary thing.
Mhm.
And she's always been like, no. And then yes. And so we're trying to trust her, but there's a lot of no's and that's too
Okay.
expensive for you.
When we've
and
looked at
a lot
kind of the advice your realtor's given you before, it seemed like your realtor's giving you good advice. And if the ones that you're moving on are going way over asking, that tells me that there's a good chance she's giving you good guidance. You know, we can't say for
Mhm,
sure. We're
mhm.
not there, and real estate's hyper local.
Yeah. We don't do much anymore of representing buyers specifically, right? Because we've moved to our private equity fund model. But when we did, we told a lot of people a lot of no's, and it was very confusing to people. Like they would call and say like, aren't you trying to sell real estate? Or like, isn't that what you do for a business? And we're like, well, yes, but we care about you. And we know that that property is a no.
Yeah.
And
It's close to a busy road. It has some characteristic that we know makes it a no-go, even if that's not necessarily obvious at first.
And the fact that we would forego income to protect you should tell you how much we care about you. So that's what I think is happening with your real estate agent too. We were so in it too, because then we had to manage it. So we would tell people, we only want to make sure that, number one, we're foregoing income every time we tell you no. That tells you that we care about you. We're not just trying to make a bunch of money as quickly as we can. And then number two, we have to manage it. So we really want to pick something that's going to provide, income for you over many, many years and not just be a big problem or lose value or whatever. So I think for the most part, and like what Nick said, we've done some deeper dives into the deals on other calls. I think you've got a pretty good agent. Is there a chance that you want something that doesn't exist? I haven't asked that question before in prior months, but now we're like 3 or 4 months into this.
You've been persistently at it and you haven't gotten it yet.
Right. You seem like you're hardworking, you're earnest about this, you're not wasting time. And yet 3 or 4 months have passed and you're not yet under contract. So your capital is getting less and less valuable. Is there a chance that we have to rewrite the whole strategy?
Well, we were going with our strategy we had before. We have one, we kept our first house. So we were just like a little single brick home, small, not too big. We are being a little bit selective in our areas. But even like in the areas like outskirts of Denver that are like not very good, they're still going for 400. And I mean, you'll see occasion, what it is there are homes here for those prices, but they're just gone so fast. Now we're teachers, right? So we're probably always late to the game and we are critically thinking about it. And I just don't know. I mean, summer's coming up. I don't know if
like late to the game as in like you submit your offer late?
Yeah, like it's amazing how quickly these are done. And like I want to actually visually go into the home before I put an offer. I don't know if like that's just, what else do you think?
Do you trust your agent to tell you this is the one and to write an offer without seeing it?
Yeah, I would.
Okay.
Yeah. She's given us like 2 that she said, those are good. And they were gone. Like when I was like, what about this one? She's like, that's good. And then it's like, oops, they're gone. Like,
okay.
I'm like,
but you were willing to write an offer without seeing it?
If she said it, but I think she would like to see it too. She's more conservative. I think she doesn't want to get us in trouble either.
Oh yeah. Someone has to see it,
Mhm.
whether it's
Yeah.
her or
Yeah.
you, but
Yeah.
I would not write an offer where no one has seen it. But
Yeah.
if she has seen it and says, yep, this is it,
Yeah.
but you're, in the middle of school and you can't get out till 3 o'clock, you may consider saying, yep, let's green light this.
Okay.
Right.
So just ask her to go and give us.
If you feel comfortable, right? Like all of this is a risk spectrum, and that's a notch further in the riskier direction. Only you can decide how much you trust her, how much her experience is. I doubt you're able to get an inspection contingency, but if you are able to get an inspection contingency, well then so what? Just write an offer on everything. At that point, you can write sight unseen offers because you've got time to inspect. But my guess is inspection contingencies are not viable in your market.
She really wants us to have the inspection, and I've talked to her about what you've said about waiving it. But I think our biggest issue is that our price range is like one of the houses we put an offer in, we went over 40,000, I think, but it went for 110 over. So then you're like, you feel like you're like taking this
so an
big
inspection
bulk-
contingency doesn't matter. That
like they don't
inspection
care.
contingencies in our market is like $10,000 difference, like 70,000.
Yeah.
No, they're going to take that top number. Something we haven't talked about before is the home that you currently live in. Could you operate it as a rental, move on to an owner occupied home? Then you could get like a 3% down. So then maybe you could go up to 5 or even 600, because if you're only bringing 3% of 600 instead of 20% of 400, right? Then you can get your you leapfrog from your old home to your current home, and that's what got you your first rental. Can you leapfrog again?
So we've thought about that. We actually found a house for like 800,000. I was like, big corner we drove. It would need so much work, but I just don't think they'll give us that money. The banks, like the next step, like our house was, we paid 525 and now it's worth, almost 8, the current
Okay.
one. We were just trying to like play with the numbers, but I don't think, so if we had renters in here, they could pay the mortgage, but I don't know. Like for us to get a $400,000 home, the renters are paying it. I just don't know. I guess we haven't inquired, would a bank give us enough to buy an equivalent home nowadays? Does that make sense?
Yeah, absolutely.
Yeah.
100%.
Even a little better.
The home that you're living in right now, could you cash flow it if you moved out and a renter moved in?
Well, I don't know how much. We did a 15-year mortgage on this because it was 2.11. And that's what we did on our other rental, and it's almost paid off. And that's kind of how we were rolling until we've heard all these people like, oh, it's good. That's kind of like was my family motto, like, no, pay off loans.
So you're not sure if it could cash flow because your debt service is so high because you have so much debt paid down.
It could. So they would have to pay, I think so. The rental right next door is going for $3,000. And it's
So you're
not
even
that-
hemming and hawing about this makes me think that it would probably work.
It could work.
And-
I don't know if I'm ready to. Oh, sorry.
And if the bank is willing to give you a loan on an investment property at 400,000, a bank will probably give you a loan on a personal home at 800,000.
See, I don't even think you need to go up to 800.
Yeah.
But if you could get to say 550,
Mhm.
right?
Get over that hump.
Because you're only putting 3% down. So then you're
Yep.
only putting, say, like 25% of your liquid cash, or 25,000 of your liquid cash down. You have 2 rental properties now. They're both cash flowing. You've got strong debt pay down to 15-year mortgages. And then that gives you a little bit more room to buy the next one. And maybe that thing's not a forever home. That's okay, right? You guys are chasing freedom, right? So you live in that home for 3 to 5 years. Maybe you do some sweat equity projects
or a year.
there, or, or just a year.
Yep. We have lots of clients that we advise. We have clients that are stretched so much more thin than you. We have clients where, we advise that they house hack. They go get like a 4-bed, 2-bath home, or like a 3-bed, 2-bath home, and like live in the basement with the kind of creepy basement bathroom.
Yeah.
And
Like our day job is working with like high net worth individuals and raising capital and spending it. But what we do for fun is help like 20-year-olds buy a house and rent out all the rooms to their roommates.
Yep.
Cause we're just like so energized by it.
Yep.
We're like, dude, you were like set, like if someone had taught us this at 20, like,
Yep.
oh, watch out.
Yep.
That
So it
strategy
works.
might not work for you guys because maybe you want to rent out all your rooms, but maybe you don't. But you could move to the next house. Maybe that gives you some buying power up to like 550, maybe 600. You move
can't
there.
buy a house in our neighborhood for 550 anymore. Like
You have to live in that neighborhood.
Well, we both can bike to work, our teaching jobs. We don't have
Okay.
to. If I go north a little bit, the houses increase. Actually, if you go south, they increase. You go east pretty far, then we can't like walk and bike to work, which that's kind of a quality of life
sure.
aspect for us. Yeah, like a 2-bedroom, 900 square foot across from a rental went for 620, and they're gonna scrape it apparently, or do an additional fence around it. So it's like, this area is just, it's gone insane.
Sounds like a high appreciation area where you'd like to own more real estate.
No,
So don't
and
buy
we-
into negative cash flow.
Yeah.
But if you can get a 30-year amortization mortgage and whatever your minimum, down payment is or whatever to make the numbers work, and the numbers work, then great. In our area, right now, 300K is probably, it sounds like 300K is about where 400K is for you. And if you're at 300K, it's hard to get a property and there's multiple offers and it bids up. If you get up to like 350K, it thins out quite a bit. So we frequently shop just above that point of competition. And the best value is rarely at the bottom of the market in any market. If you're buying a car or any consumer good, best value is rarely at the bottom of the market. It's usually right around median or just above or below median. So yeah, if it would make sense for you, I mean, it's another strategy to open up. It's another thing that you could potentially look at. And if you can tolerate doing a live-in flip and that kind of thing, And there's plenty of clients that we advise where they do one house hack per year and they'll get a new owner occupant loan. They've got 5 or 6 owner occupant loans.
Totally
that-
legal,
Totally legal, totally legal. Yep. And you get way better terms, better LTVs, better interest rates, that sort of thing. So it can be a really advantageous way to approach it.
Cool.
Stuff
We'll
to-
definitely think about that. Thank you
Yeah.
You
guys.
might be eligible for other programs as well if you do that. So most areas have different programs that advantage owner occupants over investors. That's another thing
Mhm.
that could potentially open up. I don't know about your area, but there's lots of things that, investors, have the opposite of a first right of refusal on them.
The other thing I might say is, if you were listening at the beginning, we don't think there's like some huge, market downturn or anything coming, but it does seem like the buyer pool is maybe thinning a little bit, at least right now, while people are kind of refiguring out their bearings. So what happened? When did you most recently submit an offer?
No, it's been a while. Was it
A month ago.
April?
A month ago? Like let's say a month ago, like we're in a different market. We're in a different market, right? So we're seeing in our market, those numbers were, say, 6 weeks ago, there were 20 offers, and this past weekend, there were maybe 3, right? So it's easier to win with 3 than 20. So get back in the market. Can you shop this weekend? Can you write an offer this weekend? When did you last speak with your agent?
We text her or email her a lot, and she did advise us to wait
Okay.
till July and August. She said that or June and July, things
Yep.
open up a lot.
Yep.
Okay.
She did advise
Absolutely.
us on that.
A lot more inventory.
Yep. Absolutely.
Yep. So it could be just that the market needed to, like, you and the market needed to come together, right? Like you wanted something that maybe was really, really tight, but not impossible. And now the market's opening up just enough that you can kind of swoop in. And just some encouragement that in the early days, I'm sure when people listen right now, like it just sounds crazy, the stuff we do, like, oh, we're just going to raise this much money and go buy this and do that.
Mhm.
We bought our first house was a house that we lived in. Our next one we bought 3 years later. Our next one we bought 2 years later. Our next one we bought a year later. The year after that we bought 7. The year after that we bought like 20. But those early years, we were you guys. We're like, how do we
Yep.
do this? We're like scraping together. We're like, we
Yep.
won't go out to eat one more night. Like how fast can you save tens of thousands of dollars, $50 at a time,
Mhm.
right? Like we're like, oh my gosh, like, is this even worth it, right?
Mhm.
We're sacrificing so much for this like future goal. It's so hard to like scrape together our pennies. But we did, and then we got some momentum, and then I already heard like that your first rental, you basically paid it off. So maybe you can be thinking about a cash out refi there to get you a bucket of money to go buy the next one. And that's what we did. And then it built some momentum. But just a word of encouragement to stick with it. And, I think if you stay the course and you're confident about this, the you of 10 years from now will be very glad. And you'll remember this like 4-month, 6-month period where it was really hard and it was kind of confusing and feel like you were kind of beating your head against the wall, but then you'll remember when you got the breakthrough.
Mhm.
And it will be very worth it.
Yeah.
And then just keep coming back, check in with us. I think we talk every month or so. And
Yeah, I think I need to keep coming. Yeah, because then you get like disheartened and like
Yep.
you need
Yep,
like
I remember
okay,
those
start
days.
doing it. Okay,
Yep.
I need to hear this again.
Yep. And our friends were like, real estate, like you got like Elaine's in medical school and you have a job. Like, what are you guys doing? Like, so there's all this like negative pressure from the outside. It's kind of the opposite of where the market is right now. The market was increasing. And so people are like, why would you buy when you're just going to buy at the top, prices are going to go down. I mean, this was in like 2012. People were already saying prices would go back down. So there's all this like negative energy from the outside, negative energy from the inside. And we just stayed the course, even though it was really hard, and then built that momentum. And that's the phase that you guys are in right now.
And we have the same problem, but in opposite as well. We've had, 25 million on our wait list for Fund 2 forever. And we just have to wait. We just have to wait, make sure we're buying good deals and write a lot of offers and look at a ton of properties and get, told no or lose the offer over and over and over again and just kind of stick to our guns. And eventually it works out. So
we get about 20% of the offers we write.
Yeah.
When we get over about 33% offers accepted, we know that we're paying too much.
Yep.
And when we get to 0, we're like, we're doing something wrong. We need to kind of rethink our
Yep.
strategy. We can just do that so fast, right? We can write 5 offers in one weekend. So we have that advantage. How many offers would you say you've written in the last, say, like 4 months that we've been
Not-
talking?
Well, we first did some offers in another town called Pueblo.
Mhm.
And then we moved because there's homes are much cheaper. Although we decided to go, we were considering going back to Pueblo, but they've already gone up a lot. You can't get those for like under 2 now. It's much farther drive and economy's not as good. And so we've only put in 2. We've talked to a realtor about so many homes. So
And
yeah.
then by the time you make the decision, they're gone.
She either advises against a lot of them.
Okay.
So sometimes we're like, I don't know. Sometimes I don't know, but
You
and
get
then like
feedback every single time why she advises against that one. So that
she's
you
not
can-
as descriptive, but I've been pressing her on, and a lot of it is just, you're not offering enough. It's not even going to come close. And I'm like, just do
Okay.
it. And then she'll like, let me just check with these are their current offers.
Got it. Okay.
Okay.
So you're,
We
So the
can't do-
house is good. It's not that she's saying like, oh, that
Some of
house
them
is
are not, but
Okay.
yeah,
Okay.
some of them she's
Yeah.
like, you won't cash flow. She's like, did you do the numbers? And I was like, I was just trying to hurry.
Okay.
Gloria, she's like, no, you have to, because she estimates, she's like average, it depends on the area, but like estimate, like if you're doing it quick, 800 a bed, so a 3-bedroom, you could make 2,400. And then I always go and like look at the, the rentals in that area, the part
Mhm.
the city, and to see. But yeah, sometimes I'll be like, oh, if we go further out, but then the rents aren't as good.
Stick with it.
yep.
Keep going.
So hopefully summer
Yeah.
I'll have more time because you're so diverted. Like this.
Yep.
Mhm.
Yep.
All right. Thanks, guys.
Thanks for checking in again.
Yep.
All
Go-
right.
Go get one.
All right, everyone. It is 9:15. Time flew away there. I thought we were hitting 9 o'clock, not quarter after. So thank you everyone for coming. Nalini, I saw you had a question. I don't think we quite have time for it, but if you'd like to email me, feel free, and we can either converse via email or get on a call real quick. So thank you for everyone for coming. We had a blast answering some questions, and I'm not sure if we have a date or a topic set yet for June. In July, we're having our in-person event, July 15th, 16th, and 17th. So think about coming out to that. I think it's going to be a ton of fun. It's going to be like this, except all day for 3 days with other people in person, looking at properties, having good food and good drinks, and doing all sorts of fun stuff together. So it's going to be amazing. I think that's about everything.
All right.
All right.
Thanks, everyone.
Good night,
Have a good
everyone.
night.